Thank you. Thank you. This is work with Andrei, with Rafael, Matthew that are here. Pedro, unfortunately, couldn't come. What this paper tries to talk about are the drivers of macroeconomic and financial volatility. Well, it's well known that the aggregate economy is volatile, subject to business cycle fluctuations, in which sectors expand and contract together. It's also well known that the stock market displays significant price volatility, and Schiller famously documented that this volatility is excessive if you compare it to what would be reasonable on the basis of fundamentals such as earnings and dividends. And these two types of volatility, the financial one and the real one, are kind of connecting, because it's also well known that the stock market and other financial indicators predict future real activity. So how to make sense of these things? If you start from the conventional approach to business cycles, the idea is, there are shocks that hit the economy. These are the sources of volatility, and they are transmitted, among other things, through rational expectations of agents. That's a starting point, but it's hard from it to get the excess financial volatility, which is on top of what changes in fundamentals can account for. So there is a conventional way to go to kind of fix the model by adding variation in required returns of investors, like in risk aversion, in the quantity of risk, keeping rational expectations to generate significant financial volatility for limited fundamental volatility. The problem with this approach is that it's hard to measure directly. It's hard to measure directly changing risk aversion and also changes in the quantity of risk. And insofar as you look at available evidence on expectations of future stock returns, this contradicts the rational models, because expectations tend to be high in good times, not in bad times. So what we do with this paper, we try to pursue an approach that, it's in some sense very neoclassical. It relies on fundamental shocks, but relaxes the rational expectation assumption, and does it empirically. We are going to look at data on the expectations of stock analysts about future fundamentals of listed firms. So we are going to start with this micro data of individual firms and then aggregate them up into market level measures. And in previous work, we showed that these kind of expectations depart from conventional rational expectations, in the sense that they overreact to news, they move too much, and also that they help predict stock returns both in the time series and in the cross section. Here we are going to make a further step in order to connect these expectations to the aggregate economy and also to aspects of the financial markets. What is going to emerge out of our analysis is that there is an index which we call LTG, which is expectations of long-term growth. So the long-term here, it's really important. That helps you account for significant price volatility in the stock market, for volatility and predictable reversals in other financial markets, in bond markets, short and long terms, and also in credit spread, which is an important barometer for the credit cycle. And that these also connect to standard business cycle indicators. They help you predict volatility in investment and other quantities that I will talk about. So we are not the first here coming with the idea that long-term expectations could help you reconcile financial volatility and real volatility. In the general theory, Keynes talks a lot about long-term expectations, and he calls them animal spirits. And these animal spirits, he describes them as beliefs that are very volatile because of the uncertain nature of what's going to come a few years down the line. And it puts them at the center of the nexus between financial markets and investment. And in a sense, we kind of provide evidence consistent with this approach. There is, of course, other work in macro we are related to. One is the work, looking at expectations and news shocks. Here, the difference of our approach is focused on expectations data, and our expectations are not tightly connected to future productivity as the standard news approach, because expectations depart from rationality. The second type of work is work on investment cycles. Investment is really central in what we are doing here, but the type of volatility in investment comes from beliefs. It does not come from changing prices. It could work through the supply of funds, it could work through the demand of funds, but it's not through changes in the cost of investment goods per se. And then there is growing work in departures from rational expectations in macro, and this contributes to that with measurement and also with the long-term focus. So first, I want to talk to you about LTG and financial volatility. I'll show you how we make progress on Shiller and other financial markets, and then I will look at real investment and other business cycle indicator. So Shiller excess volatility puzzle. This is the dividend discount model that is started from the price of a stock is the present value of future dividends at the constant discount rate R. And this idea was that because the dividends and the expectations of future dividend growth don't move very much, then this fundamental variation would be unable to account for the price variation that we see. And the way to quantify this was to construct a price index, P star, that would be like a rational price index, making an assumption that people are, have perfect foresight of what future dividends, future fundamentals would be. And what we did here, we replicated Shiller's exercise using earnings rather than dividends, because these are closer to the measure of expectations that we have. But it doesn't really make much of a difference with standard parameterizations for the time period that we have. And this is 81-2022, the excess volatility puzzle in our sample. The green curve is the actual stock market price, and the blue curve is the Shiller, rational expectations. And you see that, it just moves a lot relative to what would be predicted by realized fundamentals. So the standard way to kind of close the gap is to allow for variation in required return. Here we take a different route. We say, let's look at expectations data. These are available. There are stock analysts that make earnings forecast for the future for individual firms. And we have them for short-term earnings per share, 1 or 2 years ahead. This is monthly data. And then we have them for long-term earnings, which are over a business cycle frequency, say 3 to 5 years. And that's called LTG. And we have it for each individual firm each month. And so we compute aggregate indices of EPS, TT plus S, earning per share at the market level predicted for, next year or 2 years down the line. And we do the same for LTG. Then we construct a price index that, rather than using the perfect foresight of dividends, uses the expectation indices to compute 1 year ahead growth earnings expectations, 2 years ahead, and then we have LTG. Now, we don't have very long-term expectations, so we take LTG to account for earnings growth over the average duration of a business cycle in our sample, so up to 10 years ahead. And then for the rest, we just set expected earnings growth constant to a level that matches the average price level in the sample. So, of course, the success of our method is not to match the average price level, but to see whether the changes in the expectation term match kind of the prices that we see in the market as they move over time. And so this is what we get. The red line is our fitted price using expectations. It's not perfect, but it's a significant improvement over the rational expectations benchmark. It does not capture the depressed stock market of the 80s. In COVID, you know, when COVID struck, there is a plunge in our red curve because, you know, analysts became very pessimistic of earnings, but prices stayed high. But throughout, you see that you capture major episodes in the stock market using this. And if you look at the quantitative performance of the index, you see that the target, which is the empirical standard deviation of the realized stock price over 1 year, that's the first column, is 14.8%. You know, the second column is 0.7%, the rational price. It's just very far from it. And if you use expectations data, you get very close. So you get close to solving Schiller puzzle. The question is, you know, what's the role of non-rationality? Are expectations non-volatile, so volatile that they account for this? And one way in which we look at that, we say, okay, let's look at a very standard measure of non-rationality, which is the predictability of future forecast errors. And here I define forecast error as the expectations minus the realization. And so I predict that forecast error using my current index of LTG. And if the correlation is positive, it means optimism today means systematic disappointment in the future in the form of realizations below current expectations. So we do it for several measures of expectations about future earnings. 1 year ahead expectations, that is the first row. 2 years ahead expectation, second row, and 5 years ahead expectation, third row. In all of these cases, you see that our index of long-term growth expectations tends to predict the future disappointment for several quarters ahead. And these are forecast errors defined 0 contemporaneously to the predictor LTG, 1 expectations 1 quarter after, 2 quarters after, and so on and so forth. So there is this persistent excess optimism when today LTG is high. In the last row, what we show is the correlation of LTG, our expectation index, with expectations of future stock returns by CFOs of large US firms. Now, if you we're in a world in which in good times there are low expected returns, low risk premia, you would expect that correlation to be negative contemporaneously and in the nearby quarters. If anything, it's positive, which is really telling us that periods in which LTG is high are periods in which markets are optimistic and they expect, if anything, stock returns to be high in the future. So this is kind of underscoring the idea that we are capturing with this index periods of excess optimism. And as we show in related work, this helps you to predict return. So it connects to market inefficiency. The same index connects not just to the level of price volatility, but also to return predictability, both over time and in the cross section. So if you look at this, you now have found this measure that helps you think about financial volatility without much variation needed in required return, in kind of hard to measure things. And what if I bring it to other markets? Well, it is not difficult to bring it to other market, if you start from a canonical macrofinance model, because these biases in expectations actually look a lot like a time-varying stochastic discount factor. So these are two very conventional equations. The first for the current risk-free rate, the second for the average realized excess return on a risky asset in the future. And omega t, it's an index of current excess optimism that wouldn't be present in the standard model, but as we show, can be derived from a model of diagnostic expectations in which you overreact to the current shock, and then this omega t reverts back as expectations are disappointed. So it's very standard except for this omega t, where this omega t, however, and that's the important thing, can be tested because you can benchmark it against the measured expectations, okay? So it gives rise to a set of empirical prediction. The first prediction, focusing on the risk-free rate, is that if you are in a period in which omega t is large, there's a lot of optimism. That's a period in which future marginal utility is low, and so the current risk-free rate is large. But then this also predicts that in the future, the risk-free rate will revert back because expectations get disappointed. If you actually look at the equation here, you see the last two terms capture both mean reversions. The omega t terms tells you the mean reversion due to beliefs reverting. The mu gt terms is fundamental mean reversion in earnings growth. The second equation for the average realized return on the risky asset is giving you additional prediction. Now, the only source of time variation is not the fundamental mean reversion, but it's like the beliefs dynamic, the omega t thing. And what it's telling us is that good news means high realized returns, okay, or high prices for risky assets, but then going forward, disappointing returns, low average realized risk premia, which are not the expected ones, okay? And so we look at the credit spread for this, and what this is saying is that periods in which LTG increases, you get good news, you would expect low credit spread, but then increases in credit spreads in the future. So we tested these predictions looking at local projections for the 1-year change in 3 financial market indicators, 1-year and 10-year T-bills, and then the BAA spread, in which our shock variable is the change in LTG over the last 4 quarters. And then we include, a large set of controls. We control for 12 lags of the dependent variable to capture fundamental risk aversion. We capture changes in the policy rate, yearly CPI inflation, and the S&P 500 returns. And this is the type of financial markets volatility that we get, consistent with the predictions of the model, growing optimism, higher LTG revision, predict increase in interest rates at short horizon, but then a systematic decline, and also predict a reduction in the credit spread in the short term, but then an increase in the credit spread in the future. So let me just close in the last minutes with the connection to the aggregate economy. And what the connection could here be, that when there are optimistic expectations about the future, you get more lending and cheaper risky lending, and you also have more demand for capital by entrepreneurs, and so an expansion in investment. So here we perform, therefore, the same type of local projections, but with respect to the growth of the investment to capital ratio. And what we see is the same pattern. Improvement in LTG is associated with near-term higher growth in real investment, up to 2.5% extra 4 quarters out. But then, in the future, a drop in investment associated potentially with a reversal in expectations. And to look at that reversal, we actually control for the forecast errors in this regression. These are the errors that analysts systematically make in the future on the basis of their current expectations. And what you see here is that the change in LTG, the news in expectations, is associated with the investment boom, but the errors are associated with the future disappointment. So you can link financial and real volatility by using expectations data that put structure on the disappointment and the boom and bust dynamics of these two markets. Thank you.
Thank you very much.